no mutual investing. 1. High fees. Mutual funds often come with high fees, which can eat into your returns over time. Even if a mutual fund performs well, the fees can offset those gains and leave you with less money in your pocket. High fees can be a significant issue for individuals and businesses as they can significantly impact the cost of conducting financial transactions or accessing financial services. There are several reasons why fees can be high, including transaction costs. Financial institutions charge fees to cover the costs of processing transactions. The more complex the transaction, the higher the fees. Risk management. Financial institutions may charge higher fees for services that carry a higher risk of fraud or default. Operational costs. The cost of running a financial institution includes salaries, technology, and other overhead costs, which are passed on to customers in the form of fees. Competition. In some cases, high fees may be a result of a lack of competition in the market, which allows financial institutions to charge more for their services. To avoid high fees, it's essential to shop around and compare fees between different financial institutions. It's also important to understand the terms and conditions of any financial product or service you are considering to ensure you are aware of all the fees and charges involved. Finally, you may also consider negotiating fees with your financial institution, particularly if you are a long-standing customer or have a significant amount of assets under management. Lack of control. When you invest in a mutual fund, you are giving up some control over your investments. You are relying on the fund manager to make the right decisions on your behalf, and you may not agree with all of their choices. Lack of control can be a significant issue for individuals or businesses in various contexts, such as personal relationships, work environments, and financial situations. In the financial context, lack of control can refer to a few different things. Lack of control over investments. Investors may feel that they have little control over the performance of their investments, particularly if they have delegated investment decisions to a financial advisor or manager. This lack of control can result in feelings of frustration or anxiety. Lack of control over fees. As I mentioned earlier, high fees can be a significant issue for individuals and businesses. In some cases, customers may feel that they have little control over the fees charged by financial institutions, which can lead to resentment and a sense of powerlessness. Lack of control over financial outcomes. Finally, individuals and businesses may feel that they have little control over their financial situation, particularly if they are struggling with debt or other financial challenges. This lack of control can result in feelings of stress and helplessness. To regain a sense of control, individuals and businesses can take several steps. Educate themselves. By learning more about financial products and services, investors can gain a better understanding of how their investments work and what factors influence their performance. This knowledge can help them make more informed decisions and feel more in control. Take an active role. Investors can also take a more active role in managing their investments by monitoring their performance, reviewing their portfolios regularly, and making adjustments as needed. Seek professional help. If investors feel overwhelmed or unsure about their financial situation, they may benefit from seeking the advice of a financial advisor or planner. Take action. Finally, individuals and businesses can take steps to improve their financial situation, such as paying down debt, increasing savings, or finding ways to reduce expenses. By taking action, they can regain a sense of control over their finances and improve their overall financial well-being. Limited customization. Mutual funds are designed to be one-size-fits-all investments. They are not tailored to your specific financial goals or risk tolerance, which means you may be investing in assets that don't align with your overall strategy. Limited customization can be an issue in many areas, including financial products and services. In the financial context, limited customization typically refers to the fact that financial institutions may offer a limited range of products and services that do not meet the specific needs or preferences of individual customers. For example, investors may have particular investment goals, risk tolerance levels, or ethical considerations that are not addressed by the standard investment products offered by financial institutions. Similarly, businesses may require customized financial solutions that are tailored to their unique needs and circumstances. To address the issue of limited customization, individuals and businesses may consider several options. Work with a financial advisor. Financial advisors can help investors and businesses identify their unique needs and preferences and recommend customized solutions that meet those needs. Seek out specialized financial institutions. Some financial institutions specialize in offering customized financial products and services to individuals and businesses with specific needs or preferences. Consider alternative investments. Alternative investments, such as private equity or real estate, may offer more customization options than traditional investment products. Negotiate with financial institutions. In some cases, investors or businesses may be able to negotiate with financial institutions to customize their financial products or services to better meet their needs. It's important to note that customized financial solutions may come with higher costs or risks than standard products. Therefore, it's crucial to carefully consider the potential benefits and drawbacks of customization and seek professional advice before making any decisions. Performance. While some mutual funds perform well, others underperform their benchmarks. It can be difficult to determine which funds will outperform over the long term, and past performance is not always indicative of future results. Performance is a critical factor to consider when evaluating financial products and services. In the financial context, performance typically refers to the returns or outcomes generated by investments, financial products, or services. Investors are typically interested in achieving the highest possible returns on their investments while minimizing risks. Similarly, businesses may seek financial products or services that help them achieve their financial goals, such as increasing revenues or reducing costs. To evaluate performance, investors and businesses may consider several metrics, including returns. The most common metric for evaluating investment performance is returns, which typically refer to the total gains or losses generated by an investment over a specified period. Risk-adjusted returns. Investors may also consider risk-adjusted returns, which take into account the risks associated with an investment. Benchmark comparisons. Investors may compare the performance of their investments or financial products to a benchmark, such as a stock index, to evaluate whether they are outperforming or underperforming the market. Financial ratios. Businesses may use financial ratios, such as return on investment, ROI, or earnings per share, EPS, to evaluate the performance of their financial products or services. Client satisfaction. In addition to financial metrics, investors and businesses may also consider client satisfaction or feedback when evaluating the performance of financial products or services. It's important to note that past performance is not necessarily indicative of future results. Therefore, it's crucial to consider other factors, such as market conditions and economic trends, when evaluating performance and making investment or financial decisions. Alternative options. There are alternative investment options that may be better suited to your needs, such as individual stocks or exchange-traded funds, ETFs. Alternative options can be a viable choice for individuals or businesses looking for financial products and services that differ from traditional offerings. Alternative options typically refer to financial products or services that are not offered by mainstream financial institutions, or that fall outside of the traditional investment or financing models. Some common alternative options include peer-to-peer lending. Peer-to-peer, P2P, lending platforms allow individuals to lend money to other individuals or businesses, bypassing traditional banks and financial institutions. Crowdfunding. Crowdfunding platforms allow individuals or businesses to raise money from a large number of people, typically through the internet. Impact investing. Impact investing refers to investments that are made with the goal of generating positive social or environmental outcomes in addition to financial returns. To learn more about life, business, and technology, subscribe to this channel. See you on our next video.